I'm on a riverboat in East London. We're just tying up at Canary Wharf. Had I been here a century and a half ago, I'd have been in the middle of some of the busiest docks in the world. The West India docks were then at the heart of Britain's economy. Now this place is at the heart of our finance sector. Actually, the docks and the financial institutions that now roost in the skyscrapers here have a very similar function. Neither cargo handling nor banking are desirable in and of themselves, but we need them in as much as they help the rest of the economy function. Both ultimately make their money from their end customers, people like you and me. During this investigation into how we all pay for the city, we need to keep remembering this fact. This isn't magic money that clever financial types conjure from nothing. Here's economist and writer Professor John Kay.
Everything that anyone in the city earns is ultimately money that is made by someone in the non-financial economy, either you and me as savers or the companies that we work for or that produce the goods and services we buy. And in a sense, you can think of it as a tax, some of it a necessary tax, some of it an unnecessary tax, on what we call the real economy, the non-financial sector.
The financial sector is huge, complex and often impenetrable. But perhaps the most obvious place for us to start is with the fund management industry. If you've ever invested in a share ISA or a unit trust or many other common ways of saving and growing money, well, you have trusted your returns with the fund management industry. So what have you got here? What's that? Broad beans?
Yeah, broad beans there. They're just picking. We had our first lot of broad beans at the weekend. I mean, so this one of the crops which I just think is radically underrated. The other part of it is mainly...
On his allotment, Peter Comley is used to seeing his returns related to his investment of work and skill. As a small-time financial investor, he's had a very different experience, though. After a decade of nursing a withered and stunted portfolio, he decided to take a long, hard, critical look at how his investments had performed, and it wasn't a comforting exercise.
I've probably fallen into every single investment hole and trap that there are out there. I had equitable life investments, I had zero dividend preference funds that blew up, invested in the tech boom when it went down. I've done them all.
Peter wanted to know if he'd just been unlucky or just a bit rubbish at investing, so he dug a bit deeper to find out how he compares to the average investor. That turned into a bit of a project, since most of the stats that we see are about how the industry has done, how this fund or that share has performed, not how the end investors have fared.
It's actually quite a difficult thing because you have to take into account lots of different factors. Part of it is costs you need to factor in, part of it is people's skill level, in as much as that particularly when people start trading they're not very good at it. I managed to put it all together, and what it works out is that the average person is probably losing around about 5 or 6% a year.
A year?
A year, compared to what they think they are getting. The industry tries to tell everyone that the normal returns from investing in shares, you should get around about 5% better than inflation. But what that fails to tell people is that's a theoretical return.
We're standing next to your rather healthy-looking rhubarb crop.
Yeah.
Maybe an appropriate place to ask you what you think about the marketing of financial services. Do you feel you've been misled over the years by them?
I suppose as an example, I mean, I took out a with profits endowment just over 25 years ago now. And like many other people in this country, that paid out nothing near what I was expected it would. And this morning I even sat down and worked out, had I actually put it in the building society and even paid basic rate tax on it, I'd have still got more back. Most of that was invested during a period when the stock market has probably gone up about 2 or 3 times. And you think, how can that be? Where did that money go?
This mismatch between the expectations generated by the marketing and actual returns is something I've heard repeatedly in the course of this investigation. Gina Miller used to work in the marketing of financial funds. She told me she was uneasy at how, well, let's say inventive she was required to be.
I was being asked to write copy for consumers about returns on products and profiles on products. When I was reading prospectuses, I realised that actually there was a misfit there, that it made me feel very uncomfortable, that there were things they were promising investors and consumers that really these products couldn't produce. And it was about slick marketing.
At the moment, it's very easy for fund managers to obscure the real facts of their products. The reason we can't get a clear idea of how much we're paying in fees to invest is the same reason that those fees are so high: complexity. The sheer number of people involved in the process helping themselves in different but overlapping ways. Chris Sear is an independent industry analyst. He was invited to present the findings of his investigation into the complexity of the industry to the Treasury. And his first task was to try to track the number of steps and intermediaries between an investor and their investment. In the case of a simple ISA, he identified 16 steps, so not so many as John Buchan's 39, but more than the Alcoholics Anonymous 12-step recovery programme. But he says the financial services industry is addicted not to booze but complexity. To help us follow Chris's often baffling trail, we've added sound effects to indicate where fees are being paid.
The traditional model is the IFA recommends to you a fund. He makes that recommendation through a platform. They also take a cut for brokering that interaction. Once the fund platform has the information that you wish to invest and has the money, it informs the fund manager. And there are some technology steps between there where money is drawn down from you again, but we'll just keep it simple. They take your money and they give it to a custody bank. The custody bank is like the bank account. It's like a bank account on speed. A custody bank manages not just cash, it manages securities. The custody bank passes the money to the broker, who is the one that trades on your behalf. So the fund manager has a strategy. Your money has gone from the IFA to the platform to the fund manager to the custody bank. The custody bank holds it like a bank manager, and the asset manager says, I want to buy some assets over there. And then what happens is a transaction between the broker over there, who has access to the market, and they will exchange cash for securities.
We'll pause here because this is getting staggeringly complex already and, well, you're probably getting ever so slightly irritated by our cheap and cheesy sound effect. Yes, thank you. But remember, every time the bell rings, it means that you, as an investor, are losing money. Chris Sear, who you will recall prepared a report presented to the Treasury on this, believes that we should be asking a very simple question.
Why can't we go straight to market? We probably can, but we've got ourselves caught up in a position where we have to use a range of advisors and intermediaries and pieces of technology that enable us to get access to the market. And that's a very long value chain. We put in 16 steps. There are probably more.
So forget middleman here. We're not talking about a middleman. We're talking about a whole rugby team full of people.
Yeah, basically, yes, I like it, yes. Indeed. You're passing the ball out of the scrum to the scrum half who's passing it down the line to the wing, who runs in and doesn't score.
Gina Miller, who was so uncomfortable about the hidden charges when she worked on the marketing of funds, has since set up her own investment company. She says it's based on the principle of clear fees. She also runs the True and Fair campaign in an effort to spread transparency. On the campaign website is a calculator that attempts to show to potential investors the real costs of many of the leading funds on the market today. She picked a typical ISA product to show me how the calculator works. Her example assumes a product came recommended by an advisor.
You would have been told your annual fund charge was 1.42, but then you've got these other charges.
These hidden charges of the costs of buying and selling.
Yes.
And that's adding 0.31%.
Yes.
So that brings our total to 1.82% for that fund.
It would do. And then you see that the fund manager would actually be making more money than you would be getting back.
Wow.
We haven't gone through a platform or a stockbroker or an advisor yet, and we're already losing money.
So we're going through a platform
So we're
now,
going to go through a platform.
which is like like a fund supermarket or something like that?
Yes, we're going to be really conservative here. We'll just say that there's only going to be one charge here, which is going to be 0.25%. So now we're going to add on the advisor charge. Again, let's be really conservative. The only charge we're going to charge there, we're going to say 1%. And then most advisors, for the privilege of selling you a product, have an ongoing annual charge. So we're going to say that, again, this is conservative, 0.5%. Okay?
Okay, so all those numbers are now in, and now we see another picture.
Fees have now gone up to 2.57%. So you end up with the privilege of buying this product with your ISA allowance over 5 years, you've got £547 back, and at all the different levels of the chain have added up to £1,115.
It's extraordinary, really, when you start seeing these fees and these little charges and small amounts
they
and
add up.
tiny percentages added up, and they end up eating most of your lunch for you, don't they?
They do.
So this fund that looked ever so attractive in the brochure, which said it cost 1.42%, actually, when you add up all the hidden fees, cost 2.57%. You'd probably complain if a shop sold you something at one price and it turned out you'd paid 80% more, but with financial services, it's just not made clear. To provide more complete information, the industry started publishing what it said was a far more accurate measure of fund costs, called the Total Expense Ratio, or TER. On the plus side, the TER is a ratio and, well, it certainly involves expenses, so 2 ticks there. Sadly, we can't give it 3 because it's not total. Significant costs are excluded. The fund management industry says it's working to provide more clarity for consumers. Daniel Godfrey is the chief executive of the Investment Management Association.
One of the problems that the industry's had has been that it's been very complicated. And so although all the information is out there, it's very difficult for a reasonable investor to sort of pick their way through all of it to find all the pieces. And that's why the IMA has been working with its members over the last few months to develop a proposal for an all-inclusive single pounds and pence figure of historic costs, so looking back over a year, to tell an investor exactly how their fund has performed and to tell them how much a unit held over the course of a year would have cost, so they can begin to get some sense of value in a very simple way that they can understand.
An investor, after a year, would be able to look at those figures and say, well, this is how my money has done precisely in that fund over that year, and this is what I might have earned in the building society or the bank or in another fund.
Absolutely.
And do you think that some fund managers will be slightly embarrassed by those numbers when they come out?
I think that fund managers have given very strong support to this. Clearly, if your funds look very high, people may want to look at that, but I'm not detecting any signs that people are embarrassed.
Once you head down the rabbit burrow labelled hidden costs, well, things get curiouser and curiouser. You'll remember how in the 16 steps to buying an ISA, the fund manager doesn't buy the shares themselves, they have to commission a broker to do it for them. Yes, that's right, the cost comes out of the fund. Well, it seems that in those brokers' charges are fees for other stuff too, not just the execution of our share trade, stuff like research. Now, hang on a minute, you might say. Aren't we already paying our fund manager handsomely because they're a market-beating expert? We are already paying them to manage our money, so if they need research done, shouldn't they pay for it out of their annual fee like they do with the electricity bill? Gina Miller, for one, thinks so.
Paying for research is fundamental to a fund manager's job. It's the engine, it's what drives their job of delivering returns for consumers. So you would have thought it's a fundamental part of the annual management charge, because that's what you're paying for. You're paying for them to get the best possible products to get you a return as an investor. Actually, you're paying for it separately. Research should be available either free, or if it's a fundamental job of a fund manager and it has a research department, well, what are they doing? Isn't it their job to do that research?
We've moved a mile or so from Canary Wharf to another ex-London dock, gone up in the world rather. Moored here in St Catherine's Dock are, well, lots and lots of pretty huge and pretty expensive looking private yachts, and from the look of them they come from all over the world. There's an old Wall Street question that this scene reminds me of. Where are the customers' yachts? Meaning, it's hard to point to anyone who got rich investing their money with fund managers. The yachts here are much more likely to belong to the fund managers themselves, or brokers or bankers, all getting rich on fees. In fact, it's the fund management industry's guilty little secret that on average it's not a way for investors to get rich, that active fund management, that is some well-paid expert trying to pick shares and investments, doesn't beat passive fund management, that is just tracking the whole market. Oxford academic Dr. Brian Bell says this seemingly startling finding is actually borne out by countless research studies.
There's enormous academic evidence that says that's right, that In the long run, on average, it's better just to invest in a tracking fund, a passive fund, where the management fees are extraordinarily low relative to an active managed fund. And of course, the response that active management funds often make is, well, we can point to examples where someone has outperformed the market for 10 years in a row. And I guess my response to that is, it's always true that if you toss a coin 1,000,000 times, 10 times it'll come up heads. That doesn't prove the coin's brilliant. It just proves that there's randomness in this sort of stuff. And the same is true of active managed funds. You'll always find one or two that do really well consistently for many, many years. And of course, the other thing that people always forget is that when they report the active managed funds that they say over the last 10 years, this fund's made X%, it's done much better than the market, you forget all of the other funds that they've closed down because they weren't doing as well. They don't bother reporting on those anymore. So
the ones that survive are the ones that have done well.
Exactly.
So why don't fund managers, on average, beat the market? Well, one reason is the amount of money leaking out in fees. Another reason is that, taken together, fund managers are the market, or most of it, so they can't all beat the market. But is there another reason? Rick Damasio is the CEO of Inalytics, an investment data firm that's examined 700 portfolios containing $500 billion worth of assets. He and his team have looked at what they do share by share, deal by deal. In all this evidence, he's identified some all-too-human failings that only a tiny number of fund managers manage to overcome.
Human beings have this natural tendency to want to bank a profit. So even the fund managers with skill have this overwhelming human tendency to bank their profits too early. I suppose a sort of extreme example would be someone who was fortunate enough to have bought Google, say, on the flow to $80, watched it go to 200 and think, well, what a tremendous decision that was, pat themselves on the back, bank the profit, and now it's at 800. And although that's an extreme example of what I'm talking about, literally 95%, if not more, succumb to this overwhelming tendency to bank a profit and sell too early. And then the second thing that we look for, but this is as rare as hen's teeth, is the ability to admit a mistake and cut a loser. Fund managers really, really don't like doing that. And I ran money for 20 years and I didn't have that skill. So I'm talking about myself as well here. And the mind plays all sorts of tricks. You think this stock is only a matter of time before the market sees the value and that it'll come good, won't it, sort of thing. And you sit and wait, and all it does is it just costs you more and more money.
I mean, it turns out really that Kenny Rogers was right in all this. You've got to know when to hold them and know when to fold them. And know when to walk away and know when to run. Essentially, that's it, isn't it? What do we need?
You got to know when to hold 'em, know when to fold 'em, know when to walk away, and know when to run. You never count your money.
Perhaps it's the difficulty of taking Kenny's sage advice that has led some academics to suggest that even a random selection of stocks would outperform most active fund managers. For 14 years, the Wall Street Journal held a competition. Could blindfolded journalists flinging darts at the financial pages beat experts using their supposed skill to pick investments? Although the experiment was inconclusive, Peter Comley, our vegetable-growing small-time investor, believes the point is valid. He wrote a book that took its title from that famous experiment.
The monkey with a pin is just is a pure allusion to the fact that monkeys can actually do this job much better than us. And they have the real benefit that they don't listen to the media, they're not listening to radio programs like this, they're not reading magazines or anything like that. They literally just randomly pick stocks. And because of that, they tend not to get influenced by the memes and the stories of the time.
Monkeys, of course, charge peanuts.
And they charge peanuts, yes, exactly.
Of course, active fund managers don't charge peanuts. But there is another curious feature of the industry that means you can be paying not peanuts to a real human expert to pick stocks for you, but actually get a raw deal. Why? Well, because they simply ape the market. The phenomenon is called closet indexation. John Kay, who conducted a review of UK equity markets for the government, explains what this means.
Closet indexation is the practice by which people who tell you they're running actively managed funds, in fact are running funds which are very close to the index benchmarks, which are used to judge their performance. And the truth is, if your performance is being judged on a quite short-term basis, it's very dangerous for an asset manager to go very far away from the benchmark, Because if they do, even if they're right in the long run, they're quite likely to have large periods of underperformance. They'll end up getting fired or sued.
Closet indexation is caused, John Kay says, by an obsession with short-term performance. This has meant, he says, many active fund managers are now really short-term traders rather than long-term investors.
You can have good active fund management, but the key point to realise is that what fund managers are mostly doing is trying to outperform each other, and it's obvious that in aggregate they can't. The only way in which the fund management industry actually can add to our wealth is by improving the underlying performance of the companies in which they invest. Now, good long-term investors can do that. You know, that's how Warren Buffett has made an extraordinary fortune over his lifetime, by patient long-term investment, which puts in good management to companies and supports it.
Remember, there's nothing wrong with passive management. Over time and on average, it outperforms active management. But if that's what they're dishing out, perhaps it might be better to let us know and charge accordingly. You wouldn't be impressed if you found out that the expensive restaurant you were paying top dollar to was actually serving you microwaved ready meals. The asset management industry says it's recognised it needs to change and is in the process of reforming itself so that we get more value for the money we pay and more transparency about just what we're paying for. Daniel Godfrey of the Investment Management Association.
The asset management industry does a very important job for customers. People need to build resilience to financial adversity. They need to achieve financial goals. They need to be confident that they'll be able to enjoy a decent standard of living in retirement. And investment managers take their savings and they allocate it to companies in the economy. If they do a good job of allocating it to companies in the economy, those companies grow. Those companies deliver jobs and tax revenues, which supports government spending on infrastructure and on education and on the welfare state. That's a huge responsibility for us. We have to get that right.
But John Kay, who conducted a review of the equity markets for the government, is sceptical that new rules or codes of conduct or regulatory layers will do anything. What's needed is for the city to get paid for doing what we need them to do.
The incentives of most of the people in the chain are related to activity of some kind. You don't get paid a lot of money for telling people to do nothing, even though for most long-term investors, nothing is usually the right thing to do. So all the incentives of most of the people in the intermediation chain are to create activity of some kind. Now that's what leads to the world in which there's too much activity in financial markets and in which the costs are as large as they are.
Well, it's time to take another boat to leave Canary Wharf. When London's docks left here, this part of London, they headed for new modern container terminals, places like Tilbury and Southampton. But if the shipping industry had developed along the same lines of size, expense and complexity as the finance sector here at Canary Wharf, what would we see? Well, the critics we've heard from in this programme would probably say we'd see hundreds of ships, thousands even, each endlessly unloading and loading the same cargo between themselves to no one's obvious benefit, apart from, that is, the tens of thousands of dockers earning fabulous fees paid by you and me.
The reporter in How You Pay for the City was David Grossman. The programme was produced by Phil Kemp. Next week, the series continues with a look at the sometimes hidden cost of pensions.